Friends, as all you know, India embarked on the Amrit Kal journey last year upon completing 75 years of independence. India is being transformed at a rapid pace under the leadership of our Honorable Prime Minister Modi. India is today making significant strides on the global stage. While the world is still struggling to see a recovery from an unprecedented downturns of last 3 years, Indian economy has remained resilient and steered through the storms rather swiftly. The recently released GDP growth of 7.2% for 22-23 clearly highlight the resilience of the Indian economy in an otherwise gloomy global environment. India today ranks amongst the fastest growing major economies in the world, and this robust performance is expected to continue well into the future. The spate of structural reforms that we have seen over the last 9 years is phenomenal. There has been a long-term approach with forward-looking policies for strengthening the growth levers of our country. India is in the midst of large-scale transformation, be it the industrial landscape, governance structure, delivery of social services, or the broader set of economic reforms. Our country has seen changes and improvements at a scale never seen before. There has been continued focus on improving ease of doing business through legislative as well as procedural reforms. The introduction of goods and services tax, an insolvency and bankruptcy code, further relaxation of the FDI policy regime, codification of the labor laws, and ushering in of production-linked incentive scheme are some of the transformational developments that have contributed towards making India an attractive place for doing business. This has created a favorable environment for investments, both domestic and foreign investment. Not only are our domestic companies scaling up operations, but foreign investment flows in India have remained robust. FDI coming into India currently has a new export orientation. Companies are looking at India not just for its domestic market, but also for an export base for global markets. India's digital transformation has been incredible. The Digital India initiative that was launched in 2015 laid the foundations for improving digital infrastructure, improving internet accessibility for citizens, and empowering them to become more digitally advanced. Today, India is building a large set of digital public goods, be it Aadhaar UPI, account aggregator, FASTag, CoWIN, etc. All these are enabling large-scale implementation of technology. The foundational digital public infrastructure, namely India Stack, has opened up gateways for driving innovation, for greater inclusion, for improving fiscal efficiency, and for creating an equitable society. A report by Bank of International Settlements states that India managed to achieve in 7 years, up to 2019, the kind of progress in financial inclusion that would have otherwise taken 47 years, all because of its digital public infrastructure. In the area of physical infrastructure development as well, we are seeing some of the largest projects globally being conceived and executed. These match in scale and size with the ambition we have for our overall economic development, not just for the next 10 to 20 years, but for a much longer horizon. The Gati Shakti Master Plan for Infrastructure Development provides for multimodal connectivity so that seamless movement of goods and people can take place. Much better coordination between central and state agencies, setting up new vehicles and institutions for infrastructure investments, including NOBFID, addressing bottlenecks at the local level with expediency, leveraging technology, and creating smart and intelligent facilities are the hallmarks of this new approach towards infrastructure creation. Friends, the government has laid the foundation for India's journey towards a high-income economy before India turns 100. We at FICCI remain committed to accomplishing this vision for the country. Last year, we had embarked on a unique and special initiative called India's Century in partnership with McKinsey & Company with a view to identify key unlocks and key enablers that will help India achieve the vision of becoming a high-income economy by 2047. The collaborative efforts of FICCI's members across sectoral committees have brought to fore the actionable suggestions for achieving our vision. I would like to mention some of the key suggestions. India has a potential to be global manufacturing hub across several sectors. We have already seen a multifold leap in electronics, especially smartphones. Transforming India into a global manufacturing hub necessitates enhancing our competitiveness significantly. PLI schemes have been a game changer in tapping India's manufacturing potential. Introduction of similar schemes for sectors in sustainable technologies and for various high export potential sectors may be considered. MSMEs will play a major role in driving India's sustained high growth. Efforts towards scaling up of MSMEs must continue. India must nurture about 10,000 small firms to become mid-size and about 1,000 mid-size firms to become large by 2030. This would require consistent efforts in the providing easy financial access to MSMEs as well as enhancing ease of doing business for MSMEs. To ensure sustainable high growth, we need to focus on becoming energy independent. Our power demand for 2030 is estimated to double, and we must pace up our work towards provision of affordable clean energy to meet this demand. An enabling ecosystem through establishment of renewable energy clusters becomes critical. In closing, I would like to say that India has a huge potential for being a global leader across sectors, and with combined efforts of all stakeholders, including the government and the industry, we can accomplish the long-term vision of India's growth, prosperity and development. I am sure that Dr. Nageshwaran's insights on the prospects for Indian economy at 100 and interaction with all members will provide valuable ideas and suggestions for taking India's future growth trajectory forward. Thank you.
Thank you, Dr. Velu, for your address and for also highlighting the FICCI McKinsey report where we had laid down these goals and some reforms, and be happy to present to you maybe when you're back in Delhi. I now turn to Mr. Sunil Sanghai for his observations. Sunil is the chair of the FICCI's Capital Markets Committee, really guiding us in that space and one of the influential voice and thought leaders in the area of financial markets in the country. Privileged to have you with us. Over to you, Sunil.
Honorable CA, ladies and gentlemen, as you just heard, a bureaucrat, an academician, an author, a consultant, an economist, a capital market banker like me, and many others. Mr. Dr. Nageshwaran is one man, seems to have accomplished all of that. And I can safely say, and I'm sure all of you would agree, that our economy, our country's economy is in the safe hands. Today, as a capital market player, I can say is a very good day for us for two reasons. Those who have seen the headline of the today's newspaper, there are two news which are very, very good from as a capital market practitioners. The first, our central bank governor received the Central Bank Governor of the Year award. So he's judged as the best governor in the world. And the second, on the other side of the newspaper, another headline which said that inflation is 25 months low and industrial production, which is the GDP growth eventually, industrial production is higher. Now this is a rare combination to keep the inflation down and the GDP high, and we could manage to accomplish this during the tenure of our new CEA. And sir, I must compliment you for that. I'm as a practitioner of capital market, I follow budget and economic survey. My first, vaguely I remember my first economic survey, the detailed reading was 1983, I'm an old man. And since then, I have followed most of the economic surveys. The last one, which was mainly the first one, because the prior to one was, didn't have your imprint, actually had 5 very distinct features, and I just wanted to briefly mention those. And I guess those are the 5 areas which is making this impact of we could keep the inflation down and keep the GDP still higher. The first, there was a very focused approach on capital formation. Generally, the capital formation is talked about, but not so much in detail as to how, when the private sector is going through the difficulty of restructuring the balance sheet, how could you do that, how the capital formation can be facilitated. So there was a very systematic approach on the capital formation. The second, and I think was absolutely the brilliant point, was how to channelize government expenditure. We always have talked about government expenditure, where does it go, is it really useful or not. The government expenditure was channelized more towards productive asset, the capital expenditure, rather than revenue. Number two, within capital also, it was invested more in the infrastructure, which has a long-term implication. We were all surprised when the announcement in the budget happened of 10 lakhs, eventually 13 lakhs crore of capital expenditure. We had not thought of that this kind of capital expenditure will happen. And the most important is this expenditure was done with keeping the debt to GDP ratio still very moderate. So that was a rare combination, sir, you could manage to achieve. The third, your unwavering focus on inflation, and we are seeing the result of that. Fourth, and it's very important for people like us, is the putting the money in the hands of the people who need it the most. Is the slogan which you have, Sabka Saath, Sabka Vikash. That was actually a very, very evident in the economic survey also. And finally, a big commitment towards digitization, which Dr. Velu also talked about. So I think this economic survey definitely stands out as compared to the numbers of economic surveys which I have seen. And that we are seeing the result of that and going to see this in the future. So we are always tempted to take advantage of your presence. So also would want to make some points, would like to highlight for your future reference. We hope and expect and wish that you are here for many, many years to come. So there are three broad points which I would like to put forward for your consideration. One is, sir, when we were growing in the capital market, we always, during early 1990s and all, we used to talk about importance of foreign investment, FDI and FPI. And we used to compare ourselves with China. China is getting so much of FDI, how much are we getting? You know, last 10, 12 years, we have got around $500 billion foreign inflows, $500 billion approximately. While foreign inflow is important for us, it's very important to give for balancing our budget and everything else, and for our growth as well. But the history tells us for any growing economy which is moving from the developing country to developed country, the domestic saving becomes equally important, if not more. We are known as frugal society. Our philosophy is simple living, high thinking. Can we do more on improving our domestic savings? If our economy is $5 trillion, even if we increase 5% more saving to GDP, we are adding $250 billion every year as our own additional saving, which can take care of the foreign inflow, sir. The one characteristics for foreign inflow, you have dealt this subject for many, many years, you know this, is foreign inflow comes when we don't need it, and it goes out when we need it, actually. Whereas the domestic saving is going to be here, is going to stay. There are many ways in which we can facilitate that. Sovereign wealth fund, EPFO, more structure around EPFO. We can create, like Japan has the postal scheme. There are many different schemes which have been tried globally. So this is one area which I thought I should highlight to you in terms of the domestic saving. The second, in the changing dynamic, the world dynamics, sir. Post-COVID, the purchasing power of the world is changing because they themselves are going through a little bit of difficulty. Jyoti actually talked about it. We are still very significantly export dependent, and rightly so, because export actually increases, gives us a lot of employment, and also gives us the foreign exchange to keep the rupee stable. Is there anything else we can do to supplement our export, to support our export? And I think tourism is one area which can do both. Tourism can give large employment and can also give, particularly foreign tourists, can give us the foreign, well-needed, much-needed foreign inflow. Whether it is recreation tourism, medical tourism, education tourism, the tourism can actually create a lot of employment and can give foreign exchange. So this is the other area which I wanted to highlight to you as a long-term strategy as we talk about, the 2047. These are the area which you may want to think about in your North Block office as you start thinking of multi-year strategy. The third and the final point, sir, FICCI did a survey with MSME. We done a survey of around 650 MSME. we realize that as far as the revenue of MSME is concerned, that is growing nicely. That means that increased cost is getting passed on to the consumer, revenue is growing, whereas the bottom line is getting impacted. Now, when we went into the details of the data, there are two factors which came out. One is the bottom line is getting impacted because of the interest cost, finance cost, which I think will be taken care of. The interest has started coming down. The number two, wage has started increasing quite a lot. Now, I am not here to say that we should actually restrict the wages. I don't think that's going to work. But we need to work on productivity enhancement. Somewhere we need to make our labor productivity much higher so that increased wage cost can be absorbed by productivity enhancement. Digitization is one of the things, use of technology is one thing. However, there are some areas of labor laws, etc. If those can be looked at, I think the labor productivity will go up, and that will help our economy overall. It won't become a heavy cost economy. So these are the points which I wanted to highlight to you as you think of your policy directive for the next several years. I once again thank you for your participation, and this is a unique feature which Government of India with the CE's office they have set up is to go around the different cities and meet industry leaders and the business participants in their hometown. I don't think, at least I don't remember this has been done in the past. So we must compliment you for taking the time out and coming here and doing this. Thank you very much.
Thank you, Sunil, for recommending a few of the areas where the government could really focus on going forward. We now turn to the chief guest of the day, Dr. Nageshwaran, for his address and presentation. You've already beautifully introduced him as an economist, author, consultant, someone who's been in the corporate world, investment banker, etc. He's traversed all these areas, and naturally the government does benefit a lot from the experience that you have, and also you can see the practicality of the reform since we've been on the corporate side as well. So, ladies and gentlemen, may I request you to kindly welcome him with a round of applause. And over to you, Dr. Nageshwaran. You can change
Okay,
yourself.
okay.
If it doesn't work, someone.
Sure. No, I can do it myself. That's easier. Yeah, I know. Respected and distinguished office bearers of the Federation of Indian Chambers of Commerce and Industry, my colleague Mr. Kamlesh Vashni, ladies and gentlemen, it's a pleasure and privilege to be able to share the journey of the Indian economy as it came out of the pandemic and as it is looking ahead to the rest of the decade with you, and also take your suggestions and feedback and comments on that, but also to reassure you that while we are quite pleased with the way things have turned out so far, we are not unmindful of the challenges that lie ahead for us. Should I point to that? That's okay, but not the slide. No, I can tell you to move. I can tell you to move. That's okay. We'll handle it. So, as you can see, ladies and gentlemen, we are going to be talking about the following subjects. First, we share with you the perspective on the current growth numbers, which we saw about a couple of weeks ago, and break it down into different sectoral performances, how agriculture, industry, services, and the external sector stack up. What gives us confidence about the medium term? Financial and corporate sector balance sheets, the multiplier effects of digital integration, which Chairman Mr. Velu did allude to in his opening remarks as well. Then what are the various industry-wide reforms that have currently been pursued, which will pay off in the coming years? And what is the outlook for the near term? And I'll also share with you some issues on challenges. Next. As most of you know, the year ending March 23, FY23, the real GDP growth was 7.2%. The expectation at the beginning of the year was that growth will be 7 or slightly below. In fact, when the third quarter numbers, fiscal third quarter numbers came out, there was a concern that the economy was losing momentum, and I invited some journalists to a conversation in Delhi and told them that the reason why third quarter appeared to be slower was because the data for the previous years were revised higher, and that brought down the base effect, that depressed the base effect, and naturally, therefore, the third quarter numbers were being calculated on a higher base. All of us know that when the base is higher, the future growth rate numbers will look lower. It is not that the economy was losing momentum, and I was confident that the fourth quarter number would vindicate my confidence in the economy, and it did. In fact, I can tell you, without any trace of overconfidence, because Government of India revises its GDP numbers 6 times, the Ministry of Statistics, the final number for March 2023 will be frozen in January, February 2026. When the final number is frozen, I expect that number to be higher than 7.2%. So, after the pandemic-induced contraction, we have had 2 successive good years cementing the recovery. If you look at the quarter-by-quarter breakdown, I just shared with you why we were confident that the 4.5% year-on-year growth in Q3 was due to the statistical base effect and nothing more than that. Now, compared to other countries, not only on an annual basis, but even in the fourth quarter, India's GDP numbers were better than the other leading emerging economies and even advanced countries. For current financial year, of course, all of you know that we have a projection of 6.5%. And RBI also expects 6.5% for the current financial year, FY24. And both Ministry of Finance and RBI consider this 6.5%, the risks surrounding this number to be evenly balanced. In other words, we could exceed this number by 20-30 basis points, or we could fall short by 20-30 basis points. So the risk of 6.5% is tilted evenly between potential downside and potential upside. And this kind of harmony in terms of the expectations from both the Ministry of Finance and RBI suggests that we are highly confident of hitting this number, 6.5% real GDP growth. Now, if you look at the progress of the Indian economy in the global ranking, we were the 10th largest economy in 2014, and we expect to become the 3rd largest economy in 2027. Let me assure you, it is not going to happen by simply showing up there. It will happen if we do the right thing. Just to show up and not perform is something that will not help us. And if you think I'm talking about the World Test Championship, that is your responsibility, not mine. And India's average contribution to global GDP was barely 1% until the new millennium. Now, going forward, 1/16th of global growth will come from India. Of course, given the size of China and the United States, they will still be the 2 largest contributors to global GDP year on year. But India's share has gone up 6 times compared to the turn of the millennium. And India is the 3rd largest contributor to global GDP this year, FY24, and in the coming years as well. The private consumption, which obviously got impacted due to loss of employment opportunities, loss of income, etc. So you can see that the red trend line kind of came down post-pandemic to the black line. But it is good news that the black line has now caught up with the red trend line, which means the economy is now operating in terms of private consumption trend as though the pandemic did not happen. So we have caught up with the pre-pandemic trend when it comes to private consumption, and that's good news. How does the current financial year look? It's one thing to be satisfied with 7.2% in FY23, but how does FY24 look? We are, of course, barely 2 months into the new financial year, but the good news is that if you look at the multiple indicators that we track, whether it is in services or manufacturing or external sector, exports, GST collections, bank credit growth, you name them, we do have a dashboard which we track quite actively, and all of them are in light green or strong green, indicating good momentum in the economy. And some of you may not be aware, the Reserve Bank of India comes out with a monthly economic bulletin, and chapter 1 in that monthly economic bulletin has a good description of the state of the economy. It's a good read. Similarly, the Department of Economic Affairs does come out with its monthly economic report, which is also available around the 3rd week of the month. So the report for the month of May will come out in the 3rd week of June. So this is also available on the internet, and both of those reports, RBI's as well as the Ministry of Finance reports, will give you a good handle on where the economy is poised and how it is going, and also it will give you a sense of whether we are aware of what's going on in the economy, both the good and the challenging aspects of it. So please do take a look at them whenever you get time. Okay, now we move on to different sectoral performance. First, we start with the agriculture sector. Of course, right now I was in Kerala for 3 days, and it was good to see the monsoon being reasonably active, because the only thing that matters, the difference between the west and the east is that whenever some things have to be spoiled, they say it rains on the parade, right? It rained on the parade. So they use it sort of as a dampener, as something that disrupts good activity, whereas we welcome it. For us, rain is auspicious. And rain is a positive thing. And this year, of course, there are concerns about El Nino. But one thing you should remember, most drought years are El Nino years. But not all El Nino years become drought years. So it's important to keep the distinction in mind. And also the IMD forecasts El Nino to set in the second half of the monsoon season. So by then, hopefully, bulk of the monsoon rainfall should be already with us. So the monsoon has set in quite well, and notwithstanding the potential for how the monsoon will play out in the remaining weeks of the season, the agricultural sector looks to be in good health. If you look at the harvest and the overall food grain production in FY23, the tall green bar is the most recent estimate of the Ministry of Agriculture. Then you look at the middle chart that shows you that the reservoir storage is at least 20% above the 10-year average, if you look at different parts of the country. And then there is adequate seed availability with farmers for cultivation. And you have storage of wheat and rice available in plenty to ensure that any supply disruptions are handled. And in terms of farmers' own outlook and confidence, you can see the tractor sales numbers, because the tractor sales numbers have exceeded the pre-pandemic trend as well. While we have given you monthly data, if you look at the annual data as well, you will see that tractor sales are running ahead of what they were even before the pandemic happened. And fertilizer stocks are in comfortable position, helping farmers to ensure the maximum possible yield. So by and large, the monsoon does have an important sentiment effect on the economy, but in terms of handling its impact on output and prices, we are well covered as of now. Moving on to the industry and services sector, on the top left, you can see that the purchasing managers indices, both in the manufacturing and services sector, are very strongly trending upwards, whereas 50 is the neutral zone and below 50 is the contraction zone. Above 50 is the expansion zone. We can see that both manufacturing and services sector, there is confidence among the companies and firms, and they are looking to expand, and that is what these numbers suggest to us. And then you look at the construction sector, which is picking up quite strongly as captured by the steel production and cement production data on the top right. And then you have railway free traffic, and foreign tourist arrivals is now catching up with the pre-pandemic trends as well. So you have both manufacturing and services sector. Moving further on to services, the growth rate of the three sectors, on the top left, you can see that while industry growth rate seemed to have slowed, it was temporarily caused by the high oil prices last year. But services growth is quite robust, and agricultural growth, as one would expect, is steady between 3 and 4%. But industry growth, as you saw in the latest industrial production data, it is beginning to ramp up again. And the export of goods and services together were about 24% of GDP. And then if you take into consideration that imports are slightly on the higher side, given that India has a net trade deficit, as a percentage of GDP, our overall trade exposure is more than 50% of GDP. So India is not a closed economy. It is an open economy. External trade, imports and exports together equal almost half of GDP. And then you look at private consumption, it's the highest in 16 years. I know that some of us have concerns about the rural consumption. I will talk about it in the next slide. And the last bottom right is the most important one. There is plenty of questions and concerns in people's minds whether industry is beginning to invest. And the answer is undoubtedly yes. We do track both government spending as well as private sector spending on capital formation. For example, one of the private sector banks tracks 3,023 consistent sample of companies based on their cash flow statements, how much they spend on capital investment. In 2021, these 3,023 companies spent 2.1 lakh crores in the first 6 months of the year, because this comes out only twice a year. So the data for the full year will come in June, July, etc. But I have data only for the first 6 months, April to September. 2.1 lakh crores in FY21 in the first 6 months. 2.7 lakh crores in FY22. 3.3 lakh crores in FY23. This is 6 months data. So there is a very clear trend of private sector ramping up its capital expenditure. And we do expect that capital expenditure by the Indian private sector will be an important contributor to growth in the coming years. Now, speaking about consumption, I know that some of us have question marks about rural consumption. And as you can see here, in the top left chart, the first 3 quarters, rural consumption was contracting. But in the fourth quarter, you can see that the red bar has a slight blip above the zero line. And I was speaking to some of the FMCG companies, and they say that this trend has continued in the first 2 months of the current financial year as well. So the fourth quarter turnaround is not just a one-off phenomena. It is continuing. And as you can see on the right top, why it will continue? Because agriculture and non-agricultural wages are rising at high single-digit growth rates. And as inflation comes down, real wages are going to be stronger, which will support consumption in rural India as well. And the other proxy that we look at is 2- and 3-wheeler sales. They are beginning to rise as well. And the increase in minimum support prices and the Manrega program disbursals will also supplement the overall rural spending power. Yeah. As far as urban demand is concerned, and before I talk about urban demand, let's also remember one thing. The frequent classification of geographical regions into urban and rural also can distort our understanding of what is rural consumption, what is urban consumption, because many rural areas do get classified as urban after they pass some thresholds. For our practical purposes, to our eyes, they may still be rural, but administratively, they may be classified as urban. And therefore, sometimes what you see as strong growth in urban consumption and weak growth in rural consumption could also be an artifact of this administrative reclassifications. Passenger vehicle sales is pretty strong, going well, and housing new launches across different parts of the country are rising as well, because housing construction will also lead to multiplier effects on employment generation and also demand for cement and steel, capacity expansions, etc. It has got a nice bandwagon effect, which we will benefit from. Domestic air passenger traffic in 22-23 is rising, growing at a rate well above the previous 3 years, and so is credit card spend on the part of households. External sector has been one of the sources of support for us. While export growth of goods obviously is challenging, the world economy isn't growing as well as it was in the first year after the pandemic in FY22. So goods exports have stabilized at $450 billion. But the services sector exports, and even yesterday in Bloomberg, there was a big article about, anybody can guess where is the second largest office for Goldman Sachs in the world after New York? Bangalore. And many of the, and it's still expanding. They are looking at Pune, they're looking at Delhi as well. And Schlumberger, for example, the entire risk management of Schlumberger is done out of India. So it is no longer about IT and IT-enabled services. It is global capability centers in multiple service aspects, service risk management, compliance, inventory management. Most of these things are done out of India. So service sector growth, service exports growth is around $350 billion, is growing at 25 to 30%. Some of you will rightly ask whether artificial intelligence will cause some impact on this for the long term. It is gratifying for me to note here that some of the companies who are benefiting from services exports are already thinking about it. They are trying to harness the benefits of artificial intelligence for their export growth, while at the same time mitigating its potential competitive impact on their growth. So we are reasonably reassured that our companies have not lost their eyes off the ball on what AI can do to help them or hurt them. So in terms of the external sector, the forex reserves cover 10 months of imports, or slightly higher in fact right now as we speak. And the current account balance, which was a concern at the beginning of FY23 because of oil prices going higher in April, May last year, and because of higher food and fertilizer prices, but now they have stabilized. And we in fact expect in the current financial year, the current account deficit to be less than 2% of GDP, which means the financing of the current account will be less of a challenge, and it is welcome at a time when foreign direct investment, not just to India, but globally, foreign direct investment is slowing because countries are reshoring rather than offshoring. And it is due to geopolitical fragmentation, it is due to security concerns, etc. So there is a rethink on countries sending businesses and investments abroad. Given that, what is the sustainable level of current account deficit that countries can run will also have to be re-evaluated all the time. Moving on, I think Mr. Sunil Sanghi in his remarks very justifiably pointed out that the RBI governor has received one of the best governors awards, and it is very well justified and deserved, because India, this time in the cycle, inflation peaked at 7.8%. Measured inflation peaked at 7.8%. The upper end of the inflation target was 6. We peaked at 7.8 in April last year. So the deviation was 1.8%, whereas in several other developed countries, their target is 2%, but they had inflation rates of 10%. So our inflation overshoot was one of the lowest in the world. And today, the wholesale price index, because of the decline in food, fuel, and fertilizer prices, due to the base effect of last year's sharp increase, now the WPI inflation is actually disinflation or deflation, running at minus 3.5%. And businesses, therefore, on the bottom left, you can see, are expecting inflation rates to remain stable at around 4%. So we do think inflation will not be a challenge for households and the cost of living in FY24. All this is good story about last year and the current financial year, but what is the outlook for the medium term, let's say up to FY30? If you look at this chart, what you see is a big run-up in the debt ratios of companies in the private sector in the first decade, and then a pullback in the second decade because we over-borrowed and banks over-lent. The result was balance sheet strains and stress for the corporate sector and the banking sector in the second decade. So indigestion had to be managed, and corporates had to reduce their debt, sell off assets, consolidate, etc., etc. So overall corporate debt to GDP ratio came down in the second decade. Banks also reduced their exposures. They could only lend to the most credit-worthy borrower in the economy, which is the government. And that is why the government took upon itself the challenge of doing capital expenditure, because the corporates were busy repairing their balance sheets. So if we all think that the second decade saw somewhat disappointing growth performance after the heady expectations of the first decade, it is mainly because in the first decade, many of the investment and credit decisions made were turned out to be unsustainable. So second decade was payback. And now both corporates and banks are having strong balance sheets. They are willing to lend and borrow respectively. And that is why if you look at the data for the second decade, you would notice that the index of capital goods production was lower, was not rising strongly, and capital goods imports were also not growing last decade because companies simply were not interested in investing. After the first decade's over-investment, they had to get their house back in shape. And now you can see that the bank's non-performing assets ratios are much lower. Their risk-weighted capital ratios are double the minimum threshold that RBI prescribes. And you can see the result of it in the credit growth, which is running at double digits for MSME as well as other sectors like agriculture, industry services, and personal sectors as well, education, car and housing loans, etc. So this is going to be an important distinguishing factor for our growth. Second decade, we had an investment drought. The third decade, we are going to have a private sector investment plenty, not a drought. So in that sense, if international organizations think India's trend growth is about 6%, private sector capital formation can add anywhere between 0.3 to 0.5% per annum to this trend growth estimate for the remainder of this decade. And that is what you are seeing here. On the left, I'm giving you some evidence that capital goods index production is picking up very strongly, the blue bars, and the green bars tells you the construction and the infrastructure goods index, they are also rising. And as I mentioned earlier, the capital goods imports are also running at double digits. These are all leading indicators for companies undertaking capital expenditure. And last year, excepting 3 sectors, every other sector saw average capital investment growing at more than 20%. In fact, the hotels and hospitality, 80% growth in capex spending in FY23 over FY22. In fact, the total employment in the hospitality sector was 4 crores pre-pandemic. During the pandemic years, it came down to 2.9 crores, and today it is back to 4.5 crores, exceeding the pre-pandemic data. Hospitality sector employs now 50 lakh people more than it employed pre-pandemic. And how can the government or governments around the country, union and state, support this phenomena of better investments? It is by keeping the fiscal house in order. Fiscal deficit target is 5.9 for the current financial year. We look to achieve 4.5 by FY26, and more than the gross fiscal deficit. The primary deficit and the revenue deficits have come down even more meaningfully despite the pandemic era spending on health, despite security spending because of some disturbances that happened across the border in April 2020. And in spite of the welfare spending continuing into 2022, the trend towards fiscal deficit is declining to more sustainable levels. And as Mr. Sunil Sanghi mentioned, the ratio of revenue to capital expenditure has shifted in favor of more capital expenditure. As he mentioned, Chapter 3 of the Economic Survey gives you more data on this. Our revenue to capex ratio from the government side was 88 to 12. 5 years ago. Now it is 78 to 22, a 10 percentage point increase in capex and 10 percentage point decline consequently in revenue expenditure. Tax collections are both corporate taxes and personal taxes and indirect taxes are on the rise, which is helping the government undertake this capital expenditure as well as provide for welfare payments to those people who need the government support as well. And this is expected to continue on the back of strong economic growth in the coming years. Digital integration, many of us experience it on a daily basis, but it is a game changer. In fact, when we do make presentations about UPI, account aggregator, DigiLocker, FASTag, etc., many of the developed country colleagues across the table look astonished for the simple reason that they don't expect these developments from a country with a per capita income of $2,300 to $2,500. But that is what we have achieved. More importantly, we have achieved them within a framework of public-private partnership, and they are affordable, to all segments of the society, and it is not concentrated in the few private hands as it has turned out to be in the United States. The original vision of the internet was an open democratic platform, but it has not played out that way 30 years later in the United States. Whereas in India, the digital infrastructure has evolved in a manner which is affordable, sustainable, open, without concentration of power in the hands of the digital companies as well. So you can see that the online usage in India is well ahead of the world's largest digital economies, and the drivers of digital economy are basically 4G internet, digital payment index, and the trust in digital mediums as well. So my expectation is that these various initiatives, open network digital commerce, which will put world market at the doorsteps of even the smallest retailer and the smallest vendor. E-Shram portal provides informal workers a space to register themselves and avail of government benefits. And then the Swanidhi scheme is about loans to street vendors. And one of the studies of the Indian School of Business tells us that the scheme has benefited both the banks and the borrowers. Udyam portal is for MSME registration, and the registration of MSMEs in the last 2 to 3 years has exceeded the registration of MSMEs in the previous 15 years. And in this portal, you can also track how many MSMEs are actually graduating from micro to small and small to medium status as well. And once you register in this portal, you get access to various government services, including financial assistance. And as some of you might know, in this year's budget, we had a very, very landmark provision inserted, which is that no large company, public or private sector, can claim deductibility of payments to MSMEs unless those payments are actually made. So you cannot claim to buy things from MSMEs and not pay them, but at the same time claim them as tax deductible expenditure. So these are all the ways in which we are trying to make sure that the working capital needs of MSMEs are addressed. And also the using of GST invoices as collateral for working capital loans is gathering steam as well. And account aggregator enables you, with the stroke of a few buttons, transfer your own information with your permission across financial institutions to avail of various financial products, from insurance to credit to investments, etc. And these are cumulatively, these developments will add another 30 to 50 basis points for average growth for India. And that is the reason behind my optimism, that when World Bank and the IMF think India's potential growth is 6%, I'm going to add another 60 to 100 basis points to that number due to two factors. One was higher capital formation that is likely this decade from the private sector because the balance sheets are strong. And second, due to the digital transformation of India, which will add another 30 to 50 basis points to average real GDP growth this decade. Labor market conditions are improving. This is the quarterly unemployment rate produced by the Ministry of Statistics. And also you can see that in the net subscriptions to the employee provident fund organizations, because this reflects the hiring of people with monthly income of 15,000 rupees or lower. So the net increases in EPFO subscriptions together with the falling unemployment rate is a good indicator of the health of the labor market as well. Industry-wide reforms, I don't need to go through them item by item. Single window approval systems, the credit guarantee scheme, which succeeded very well in stabilizing the MSMEs in the pandemic years, it is being extended. Payments to MSMEs is eligible expenditure only after the payments are made, as I mentioned earlier. Fiscal support for the development of semiconductors and display manufacturing in India, and the PLI scheme for manufacturing high-efficiency solar photovoltaic modules in India as well. As far as the digital reforms are concerned, single window system for export clearance, SEZ units to be integrated in the customs electronic system, blockchain-based electronic cargo tracking, etc. And the National Highways Authority have started accepting electronic bank guarantees as well. These may appear granular and specific, but ultimately the ease of doing business lies in these specific procedural formalities rather than headline reforms. And logistics efficiency of India in across different aspects of logistics and last mile connectivity has been improving based on the World Bank index. Going forward, the national logistics policy will help decrease logistics cost and lead to further improvement in our export competitiveness. But you know very well that in a decade when global growth is going to be slow, while these things will help on the part of the government, the private sector also must invest in R&D and quality improvement. India's R&D spending, research and development spending by the private sector is one of the lowest. Mr. Naushad Forbes has written quite a few articles on this in newspapers in the last several months. So the private sector has to step up its focus and think long-term about R&D spend and quality improvement as well. And in terms of the startup ecosystem, it is not just about the focus on unicorns. In fact, many of the unicorns might have become non-unicorns after the market value erosion. But it is not about creating startups with $1 billion valuation. It's about the ecosystem. Today, India's startup ecosystem is not confined to the big metros. It is in tier 2 and tier 3 cities. And many engineering colleges, business schools, management institutions automatically have an accelerator, an incubator, etc. So the culture of entrepreneurship is beginning to seep, and it is an alternative to looking for paid employment, because you can then generate employment for others as well. So over time, India's startup ecosystem will also be playing a much bigger role in sustaining economic growth going forward. For the near term, as I mentioned earlier, outlook is most evenly balanced. Lower oil price, lower commodity price, a reasonable monsoon, and the lagged effect of the last 6 years of reforms such as GST, IBC, Real Estate Regulation Act will support growth, and of course government's capital expenditure. What are the risk factors? Well, the Federal Reserve may still tighten interest rates, as they said yesterday. They may still have 2 more rate increases. And of course, the monsoon may be much weaker than we expect. While we think it will be close to normal, it could be much weaker than expected if rains do not come through as we expect. And of course, the slowdown in global economy can affect export growth as well. But more than that, for the medium term, we have to ensure that India has energy security. We are coming under tremendous pressure, and also it's good for us in the long term, no doubt about that we have to diversify away from fossil fuels because we depend on them through imports. We need to have our own energy sources. It's a security issue as well. But at the same time, the transition cannot be overnight. The transition needs to be managed. And coal and gas and oil will continue to play an important part, because that is what will give us affordable, reliable energy, ensure economic growth, which will generate the resources to provide for energy transition. So economic prosperity and climate-related energy transition are not in conflict with each other. One is a precondition for the other. Growth is a precondition because growth generates the resources required to finance our energy transition. So we need to maintain the fine balance. But the global discourse on carbon emission mitigation and energy security can pose very big challenge, not just to India, but several countries in the global south. The other issues that we need to tackle are, of course, the lost years of schooling because of the pandemic. And then we need to ensure that our demographic dividend is indeed a demographic dividend, and that requires focus on skilling in areas of green technology, artificial intelligence, and also other infrastructure skills that our industry would require. So skilling 4.0 or skilling 5.0 has to become a reality. And we cannot increase our manufacturing share of GDP without having affordable and reliable electricity supply. And therefore, DISCOM reforms in the states need to happen. And then last but not the least, encouraging the harnessing the Nari Shakti or women's participation in the economy, which is still a relatively underexplored aspect of the Indian society, will also be a huge contributor to India's economic growth. There is plenty of things I can mention. I mean, after all, we are still a $2,500 per capita economy, and there is a lot of room for catch up. But I will not look at these things as problems. I will look at them as low-hanging fruits which actually give us the upside as investors and as a country. So India's challenges or ongoing work in progress issues are basically stepping stones for our economic prosperity. Thank you very much.
Thank you so much. I think you've given us a real flavor of what's really happening in India. I think, ladies and gentlemen from the businesses here, so definitely this is the best time to invest. You did talk about the digital financial infrastructure and the startups, and two are quite interlinked because, this has really led to proliferation of a lot of startups. And when we have these startups and unicorns, so there's been a news item recently which talks about how the employees of the unicorns themselves have started to get into startups. So that's how the entrepreneurial ecosystem is being given a push by the government. I think many important aspects being covered in your presentation, but more importantly that despite everything that is positive in the economy, the government still has a very sharp focus on reforms, including ease of doing business, cost of doing business, and just the appropriate areas where they need to really continuously look at and focus on. So thank you so much for sharing all of that with us. We do have some time with Dr. Nageshwar as well as Kamlesh Ji, who's here from CBDT. He's been kind of responsible for several tax reforms. So I think a good opportunity for all of you to raise any questions, any comments that you would like to share with both of them. So you may just raise your hand, introduce yourself, and give a question of yours. I'll request Sunil to kindly help us moderate the Q&A. We have time. I think we have about 20 minutes to go for that.
This is your opportunity, your chance. You have CBDT and the Ministry of Finance both. So please ask all the difficult questions. I would just to organize, I'll go to the last row first. The people right at the back, if they have any question, then we'll come forward from there. So I saw some hands right at the back behind. Yeah, so why don't you go there, then center? So, mic will reach you. If you can take all the mics right behind, just we'll finish that and then we'll come forward.
Hello.
Yes, right. Just introduce yourself, your name, and then please ask the question. So please go ahead. Yeah.
Happy afternoon, sir. This is I'm coming from Divya Sharma Financial Services Private Limited. My question is, first of all, I'm very proud and pride because Indian economy is one of the fastest growing economy. So actually there's a special thanks to Mr. Nageshwar because they beautifully presented to Indian economy. So my question is, Indian economy, major 8 sectors, coal, crude, oil, natural gas, refinery products, fertilizers, steel, cement and electricity. This is the 8 major sectors of Indian economy. Upcoming election comes, no? This type of upcoming election comes. There's major sectors. Any policy changes to be comes from these sectors?
I don't have a specific answer to your question. These are ongoing things, and the government has notified its policy with respect to energy transition, and the government's own capital spending plans for FY24 are geared towards infrastructure sectors, and the growth in the construction sector, as I showed you earlier, will also help in cement and steel production. So I don't have any specific answer at this point to you.
Thank you.
Can you just pass on the mic to the gentleman here? right.
Sir, good afternoon. This is Krishna Kumar from Malladi Drugs and Pharma.
Yeah.
Actually, it was a very good presentation and everything looks positive. It not only looks and it is positive and will be positive. And thanks for bringing this positive vibe to across everybody here. My question is whether the de-dollarization is really happening in spite of all this growth. De-dollarization is whether it is really happening, or we can put it in this way: when rupee will replace the dollar.
Sure, I fully heard your question, but look, these are all long-term phenomena. These are not going to happen overnight. If you look at dollar share of global trade or trade in the financial markets or as a share of investment flows across the world, even direct investment, dollar still dominates. And the advantage for the US dollar is that there is no obvious alternative in place at this point. And the use of a country's currency internationally will naturally expand as its economy grows in size and its foreign trade also expands. So just as is, I mean, even now today, if you look at the share of the Chinese renminbi in global trade in several matters, it is in single digits only as a percentage. So this is not something that is going to happen overnight. It is a work in progress. It is probably a multi-decade process. To the extent that we can strike these arrangements with neighboring countries and other trading partners, it does relieve the pressure to look for the US dollar as a settlement currency for both trading partners. So to that extent, at the margin, it is welcome. But it is not something that is going to transform the world of invoicing overnight.
The lady there in the center. We can come to the center row, please. Lady, why don't you? Yeah.
So my name is Gauri Kumar and I work with Dynamic Group here in Chennai. I work as the HR and operations head, so my question probably is not even anywhere close to the generic questions that everybody asked. Mine is going to be very laymanish. And being in HR, I would like to ask you, sir, we are seeing a lot of layoffs, global layoffs. India, a lot of companies in India, especially the private sector also. So I am wondering, is there any ways that you did mention that the government tracks the private sector investors? You were talking about reshoring versus offshoring. So is there any ways where our Indian youth can have some kind of reassurance, or how do they deal with it? Are we looking at a recession, or... So that would be my first question. Don't they contribute to the Indian GDP, the youth of India? So how do we go about it? How does the government tackle that?
So I'm not sure I fully comprehend the question, but the global economy at the moment isn't really entering a recession. In fact, the United States economy is quite robust, having withstood 500 basis points of increase in interest rates. And even Europe is doing much better than what one would have expected. The formal sector employment growth until now has been quite good. And in fact, the IT sector had a very strong growth year in FY22, and FY23 would be slightly slower, and so will FY24 because of the fact that there was a strong boost to hiring in FY22. So, but other sectors will compensate as the economy in domestic areas picks up momentum. I mentioned the construction sector. I mentioned the fact that capacity utilization is picking up in several sectors where companies have to go for additional capacity, which will